What do private equity firms look for in an investment? Ever wonder how private equity firms decide what businesses or real estate to invest in? They don't just throw money at everything, they have a strict criteria. In this video, I'll break down exactly what they're looking for. Most investors focus on just buying good deals. But private equity companies, they think different. They're not just buying assets, they're creating value. In this video, I'll show you exactly how they pick the right investments. If you've ever wanted to invest like a competitive private equity firm, then stick around. I'll show you what they look for, how they analyze their deals, and how you can apply the same strategies to your own investments. By the end of this video, you'll know exactly what private equity firms look for in an investment, what makes a deal worth pursuing, and how you can apply these strategies to grow your own wealth. So first, the private equity mindset. This is all about value creation. Most private equity firms don't just make investments, they buy assets or businesses and they improve them. This is a key strategy for them to drive higher returns. They look for underperforming businesses and pieces of real estate and then they fix the inefficiencies. They're not just focused on the price of the business or real estate, they want to find those operational improvements they can make to drive up the values. The goal of any private equity firm, increase cash flow, lower operating expenses, and fix the inefficiencies, ultimately exiting the assets at a higher price than they originally bought at. Here's some key criteria that private equity firms use to evaluate their investments. Strong cash flow potential. They want to see consistent revenue and profit margins over a long duration of time. A competitive advantage. The business has to have a unique value proposition, brand identity, and a strong market position. Operational efficiencies. These are fixable problems that can be improved through operational expertise and management. Scalability. This means the availability to grow revenue without increasing the operating costs. Industry trends and market growth. They're looking for favorable macroeconomic trends that sustain long-term success in the asset class. Some examples of industries that private equity really loves right now is home improvement or home services companies, roofing companies, security companies, pest control companies. All these businesses have recurring revenue and there's more demand for these types of companies, and private equity firms love buying them up and growing and scaling them, adding value. Also in the real estate space, private equity firms have jumped into self-storage, mobile home parks, and small bay warehouse. There's a high demand for this type of real estate, and there's a strong recurring revenue component of these industries that generate sustainable cash flows in an up or a down market. What private equity firms look for in real estate investments. Private equity firms love to buy real estate, but they don't buy any property. I own a private equity firm called Patriot Holdings, and we raise a series of funds, pooled investment vehicles, that go out and acquire alternative commercial real estate assets. Then we go and execute on the private equity plan or playbook. We look at self-storage facilities. Why? Because they have a high demand from our customer base, they're recession resistant, they're steadily cash flowing due to reoccurring rents, and there are high profit margins because it's a low maintenance business. Mobile home parks, huge demand for affordable housing and high profit margins since we don't own any of the homes. It's a land lease community model. We rent out the spaces and the tenants own their own homes, driving more profits to the assets. Warehouse and industrial properties. These are in high demand and private equity firms are gobbling them up due to the need for space for home service businesses and e-commerce businesses that need a warehouse, a small office, a bathroom, and affordable space to run their businesses out of. What makes a real estate deal attractive to private equity? First off, it's below market rents. With improvements made to the property, there is substantial rent growth on these assets. Underperforming assets that can be optimized through management. In the self-storage space, many mom and pop owners that have had their businesses for 20 years don't know how to advertise. They don't put in the marketing. They don't have nice signage, not nice curb appeal. So better marketing creates a higher possibility of revenue. Private equity firms always look for strong population increases and business growth within that region. This drives more demand to the property and increases the long-term possibility of growing the asset appreciation. So what is the role of debt and equity in private equity investments? Some people don't know this, but private equity firms use debt to acquire assets that generate higher returns for the investors. The key is to get low-cost, affordable debt so the cash flow from the assets accelerate the returns to the limited partners or investors. For example, If our firm buys an industrial warehouse property at a 7% return or cap rate, and we're borrowing at 5%, there's that yield or that margin that we're able to pay the investors the cash flow. So after we buy a property, we'll stabilize it by increasing the rents, possibly adding more units and improving the asset, and then our stabilized yield on cost or our stabilized cap rate could be a 9 or a 10, but our debt stays fixed at a 5% rate, so we make higher profits for our investors with that spread. This is how private equity generates above market returns. Common red flags to look for in private equity if you're considering investing in one of their deals. Inconsistent cash flow. If cash flows are inconsistent and risky, be careful getting into that investment in private equity. No clear path of improvement. If the business or the asset, the property is already optimized, there's not a lot of room to improve it to generate higher returns. Industry headwinds. If the macroeconomic trends are not supporting the asset class, don't invest in it. Office space in core markets is not doing well right now, so a private equity firm buying office in downtown San Francisco might not be the best choice. High operational risk. If management is weak or operations are inefficient or there's key talent missing in the deal structure, then be careful. That private equity investor is probably not going to be successful. So how can you invest like a private equity firm? Step 1, look for investments where you can add value immediately. These are also called underperforming assets. Step 2, focus on cash flow businesses or assets with future growth potential. Step 3, use debt responsibly. Don't over leverage the asset, and if it's managed properly, it will accelerate returns. Step 4, diversify across alternative investments like real estate, private equity, and high growth industries. Step 5, partner with experienced operators. My company, Patriot Holdings, is a private equity firm that's been around for almost 20 years. We know the red flags, what to look out for, and what are the key things to focus on that are going to give you that value add creation, accelerated returns. So now that you know what private equity looks for when investing into an asset, let's dive into the next video of evaluating real estate or businesses like a private equity pro. So click on the next video and we're going to go into how to analyze investments effectively so you can buy the right assets in your portfolio or align yourself with the right private equity firm that follows along with these key strategies to make sure that you make long-term durable returns. So click that link and let's dive into how to evaluate these investments so you are successful like a private equity firm.